Great. So hi, everybody. My name is Rob Geils, and I just want to introduce myself, and our panelists will introduce themselves. My name is Rob, and I am a real estate broker at the Corcoran Group, which is a very large real estate broker that works mostly in residential real estate across the country. I'm a Manhattan real estate broker, and I run a team here out of Chelsea. And I'm not going to talk a lot about Manhattan residential, but I just want to give you a little overview of what we're seeing here. Third quarter was really rough because we had a second major event along with the banking crisis that had really created some upheaval. I don't know how many people here have a mortgage under 3%, but I do. And what that has done is caused a kind of a tightening of inventory. A lot of people are stuck. They don't want to move. They don't want to sell. And, you know, when rates are 6 or 7%, it caused a lot of the market to basically freeze up. But that said, 2023 was not as bad as we thought it might be. And 2022 was such an amazing year that, you know, we're comparing everything this year to, you know, we're down 20% from the best year ever. So I don't really know if it's really relevant, but right now we're having kind of an average volume of sales, let's say 200 contracts a week in New York. What was really, really interesting that I thought was relevant to everything that we do here is that in third quarter, we had all cash deals took up about 65% of the deals that we were doing, which is totally the opposite of what normal is. Normally, we have 65% financing and 35% all cash. Last week, the 200 or so contracts that were signed went back to the normal ratio where we had 65% financing and 35% all cash. So that tells me that the market's kind of digesting these higher rates. And I think that really portends really well for, you know, the residential real estate market. What I'm going to do is introduce everybody and have them tell us a little bit about what they do and what their business model is. So let's start with Ross, who's been a panelist and a moderator. You finally get to talk about what you do, okay, as opposed to ask questions.
Great, thanks, Rob. Ross Weiner, Gemsco Capital. Basically, I'm a real estate entrepreneur and wear a couple different hats. One is as an investor and principal, and the other is as an advisor. And they at times they overlap. We work with family offices, high net worth, institutional partners. So they're partners of mine in deals, and sometimes they're clients of mine. And this year, what I've been most active in doing and trying to do is a couple of different things. One is I've been involved with a single family home rental startup venture capital backed business that I think we've talked about here before, which, you know, that's been a very hot growth investment area in the market. The company I'm involved with, they have a unique approach to what they're doing in terms of they offer a structure where the tenant basically has a participation in the upside of the homes and gives the potential purchaser a lot of optionality. I can go into more detail on that later. The other part of the business that I've been focused on is real estate private credit lending business. You know, given where interest rates and inflation have gone, and with the bank crisis that we had in the spring, you know, a lot of the bank lenders are completely out of the market, and you still have lots of projects, particularly on the multifamily side, condo and rental, where they're either mostly completed from a construction standpoint, or they're in lease-up mode, or they have condo inventory, but their loans are due, their banks won't refinance, there's no traditional lending sources, so a whole private market has developed, which is kind of a high-yield lending market at pretty modest values, and it's a very interesting business, very competitive, very pricey. So apart from those couple of things, I'm also active in public markets and follow real estate sector to help guidance where the markets, the private markets may be going. I guess so. Wasn't mine. I hope that was favorable.
Exactly. Okay. So we have Ron Devari. Why don't you, he's a late arrival, but thank you very much. Tell us a little bit about your sector and your business model.
Commercial real estate and residential real estate is more or less for us is one of the many asset classes that we cover because we are a generalist. We started out in the structured products. In the structured products, you really need to look at everything. I was very much involved during the credit crisis during and after BlackRock, trying to restructure many things. And so our first foray was obviously to get into distress, then was single family rental, flippers, and we kind of kept chasing this stuff. And every time we got in, somebody else much bigger came to us and destroyed the market for us. So we are a value buyer. So we focused on single family super jumbo mortgage, our first fund, 2015. And that pretty much, we're in the very last two loans of that. We were able to secure over 300 million total. And that was for us at a 50 to 65% LTV at 8% coupon. Starting in 2016, that was a no-brainer. It was pretty good yield, but the challenge was scalability of that business. So we decided that we would not be able to take that into essentially a permanent capital structure. For some of you, I was involved with PennyMac. PennyMac is a vehicle that obviously went back to become Countrywide 2.0, which is not what I wanted to do in life. So what are we doing now? I think we are seeing actually quite a bit of cross-section of sustainability, if you will, new concepts in real estate, and be able to look at real estate in a wider global sense. We're still seeing a huge amount of need for affordable housing. That is, if you're in LA or in San Francisco, there are a lot of homeless people that cities are paying $600,000 per unit to be able to place these people. There is a whole new construction technology coming in. If you're in Africa, any country you go, they can tell you that they need at least 1 million plus, affordable housing being built. So we're working a lot along that direction with being able to advise first on some of these concepts and be able to secure funding. But on top of that, I think, and obviously the development banks and multilaterals are a big part of that, and that's something we have had experience with. And we've also have a capital markets. They're trying to get some of these family owned real estate firms that are, they're getting to a point where the growth is being, they were growing at when money was cheap. Now they're having issues when they were pricing their properties at 4% cap. Now they can't even get that at 6 or 7, and wall of loan maturities ahead. And we're also seeing, coincidentally, wall of private equity coming to the terms needing financing. So there is definitely competition going on in terms of where people want to put their money at, and real estate becomes one of many areas where yet has not become cheap enough. In my view, I think you got to look at. It used to be location, location, location. I think is now asset type, asset type, asset type. For example, I think you're seeing also quite a bit of opportunities in industrial zones where you're bringing manufacturing from abroad to U.S. and getting quite a bit of subsidies in places like Virginia and others. Even Tesla has made itself available to those opportunities. So I think as an asset class, if you open your eyes, there's always good opportunity to get to what I consider higher returns, but you just have to be able to be agile. And again, we tend to advise how set up funds and also do valuation, and commercial real estate CMBS valuation is one of our continuous earners. And we're seeing quite a bit. Looking to CMBS, you get a lot of information. and that information is available. A lot of people are not looking at it, and you can see the maturity, you can see what is coming up, and that gives us a bit of a leg up over people who are just looking at real estate and not looking at the financing side of things.
Okay, cool. So, Carol,
Yes.
forgot to talk to you at the Barishnikov. Tell me about your business and how it relates to real estate specifically.
Sure. So I've had my business, Pepper International, for the last 22 years. And I set up family offices for people all over the world and act as an external chief investment officer. Many of my families own a lot of real estate and invest in a lot of real estate globally. So I have that perspective. I also speak on Bloomberg Television once a month talking about the markets and interest rates on the Daybreak Asia show. And I am a member of the advisory committee for the United Nations Capital Development Fund, which looks at financing the 46 poorest countries in the world. So it's very interesting. And I would say real estate really touches every family office that I work with. There isn't a wealthy family out there that doesn't own a bunch of real estate generally. In some countries, it's a lot of land. It can be family ranches. It can be commercial buildings downtown. It can be hospitals. I mean, people own all kinds of real estate, both legacy real estate, and then some people, it's their entire business is real estate, and they have a family office sort of embedded or are starting now to pull that family office out of the real estate holdings and create it into a separate entity. So I would say this year, and I agree with you, 2023 has been kind of a rough year, obviously, with the higher interest rates. But it's all in comparison. So for families coming from Europe and LATAM, particularly families that I'm working with a number of families right now in Mexico, US looks like a great market to invest in because they're worried about their governments going hard left and expropriation of assets. So there are a lot of people in Latin America, Colombia, Mexico, Bolivia, all these different countries bringing assets over here, and Europe as well, because in Europe, of course, they're very worried about Putin and the Russians. So there's this mass amount of money coming in from non-US investors into the US market looking for the steady Eddie, cash flow generating real estate. Obviously, real estate that is being subject to, higher rates now and can't easily refinance is much more risky, but they're still coming. A lot of them have a long-term perspective. A lot of them are buying hotels right now, for example, because they know the hotel business at home in Europe. They like the US hotel market. And so with prices lower or some deals leveraged, they like to come in and grab that. There's also a large amount of building going on in Mexico itself, with Americans going south of the border, either for retirement, investing in condos and various wellness developments, et cetera, along the coast, both on the Pacific and the Atlantic side. And then a tremendous amount of nearshoring. So people taking their operations from Asia, plunking them in Mexico. So there's a tremendous amount of building of industrial facilities going on right now. And people are making a boatload of money, both Americans, some of them are doing it with American partners, some of them are building it as Mexicans and then offering it to global. In addition, I'm involved with a company over there where we're starting called Arquitecta, where we're starting to do the global net zero and green footprinting for all the real estate in Mexico, because there's a massive tax coming into Europe called the carbon border adjustment tax. And any kind of good or service you're trying to bring into Europe, you're going to have to be reporting on how much greenhouse gas was involved in making that product or service. So we're starting to see people, particularly outside of the US, that want to import goods into Europe, measuring the greenhouse gas footprint of the real estate of the factories where these products are made that are going to be imported into Europe. So that's a new venture that I'm involved with as a partner, which I think is very exciting. So the ability to reduce your carbon footprint on your buildings, whether it's through better energy systems, better air conditioning, solar, all green building materials, all of that is starting to become of heightened concern to the investors outside of the US who are importing into Europe. So it's very exciting times.
Absolutely. And I love that every one of us has that common feeling of the environmental issues are now becoming, important in almost every business. Ross, your business with housing, what considerations are they looking at environmentally, regulatory, environmental, and is there an opportunity there?
With the single-family home rental business, which I'm an advisor and an investor too,
Uh-huh.
so I don't have really the insight into that in particular.
Right,
I haven't seen that come up.
Okay.
Doesn't mean it's not there, but I haven't seen it come up. I know it's present in some of the other single-family home rental models that we've seen,
Mhm.
some of the build-to-rent where they're building using kind of, prefab or 3D printing
Mhm.
stuff, and the kind of materials that they use, they claim to be very environmentally friendly and conscious,
Mhm.
but, I can't verify that.
Okay, and you mentioned one of your businesses is in that
Sure.
area.
Yeah, we actually have teamed up with, in our capital market side,
Mhm.
trying to raise some GP money for a very advanced concept where the developer is primarily focused on building communities that are cardless.
Mhm.
That means, within, they're not even allowed to have, there are rental concepts. And there are, the very first one was actually built in a very unlikely place, Tempe, Arizona, which is really hard. If you don't have a car
Yeah.
and you live in Tempe, how do you actually live? So the whole idea is, to create a self-contained and also have access to electric vehicles that are rentable that we can take, but you're not allowed to do that. And the assumption was that they can actually get premium rent
Mhm.
because there is a whole class of younger generation, if you will, that are very much care
Yeah.
to do
The
that, and they
demand,
pay
yeah.
the premium, and they were able to cut deals in both Atlanta and also in Colorado.
Mhm.
So I think, and it's very much backed by, I think, some of the VC big money, and so it's not like, a couple of people doing it. So I think that concept will definitely catch where you're actually building the entire community around being a zero carbon net. Second is we got involved with a project in one of the islands in Bahama to create essentially a full villa system, very high end, $5 to $10 million zero carbon. Still haven't been able to get the funding for the $2 billion that we need, but it's, the developer has enough strength to go forward with. You also find it that actually people outside of the United States, when you get into new developments in Africa and affordable housing, they're a lot more interested in build tech, build tech that is green. They're actually in parts of Africa, they're utilizing green concrete. They're using kenaf as a product or hemp as a way to build, bricks and stuff like that. So we're going to see a lot of technology, which we look at very in the build. If you're really going to get into it, it's best to get into the technology side, get a full understanding of what's coming up. And I think with that in mind, developers are very smart to jump on any new gimmick. So if you're behind, what happens is that the old properties are not going to value the same way if you have a green property.
Mhm.
So 10 years down the road, 15 years down the road, you're looking at a situation where you really have to put, new money in the old property to get it back to some of the new properties. So I think greenhouse, I'm sorry, in terms of emission, even though US, California is about to pass a law, we're seeing in Europe, that's already in place. One fact is that I've spoken to a lot of real estate people in the US. You say, are you interested in DMRV? So what the heck is that? It's a digital measurement, reporting, validation, and registration of your carbon print.
Right.
In Europe, when you talk to them, you already have an instant, how do I start measuring? And that means, you have to go back to core electrical system, core energy consumption, take data every 5 minutes. And if you came from COP28, you would know that is where a lot of people are putting money on the software companies that are actually trying to make the buildings to be able to report. Even Larry Fink himself cannot report today what's happening in Hudson Yard in his property, and he will be questioned for that.
Right.
And if you're not measuring, you're not managing, you're not compliant. So
Yeah.
I think that's coming. There is no doubt that even though it's voluntary today in the US, it will become mandatory whether you like it or not.
Right, and we market properties based on that as an amenity, the thought that environmental friendly buildings are worth more, they're going to remain worth more, and conversely, older pre-war buildings, which had a lot of cachet and extra value, are now becoming kind of a white elephants in a lot of cases. We're in contract on Park Avenue, and my buyer is being forced to replace the entire HVAC system and the windows to comply with local law 97 in New York, which, you know, we think is onerous, but other places it's like that's normal operating procedures to, you know, have people build to the highest level of environmental efficiency. Here we have to kind of retrofit the entire city. Carol, what do you think about that as an opportunity? We're talking about alternative real estate. And what does that mean to you in terms of what these opportunities are? I mean, I feel like we have to invest in future technology here.
Yeah,
So,
I think it's really exciting. In fact, I've been working on, because the next set is if you have a building site, let's say, or a development, you measure your footprint, you then improve. The job is supposed to be measurement, see how much carbon you're emitting, improve your operations, fix the HVAC, put in the solar, whatever you're going to do. And then whatever's left over, offset, meaning you go buy carbon credits to offset your footprint. So I've also been working on a business to help do the last set, which is actually have really good carbon credits that you can use to offset. But I predict eventually some of these buildings, for example, I've talked to Aldar, which is the largest real estate developer in Abu Dhabi, multiple billions of dollars. If you want to see what it looks like on a big commercial scale, go to the aldar.com website and pull down their net zero report. It's really interesting reading because they're attacking it on every level. They're a public company in an oil producing country, and they're doing everything. They're retrofitting the buildings, they're putting in solar, they're getting electric vehicles to go around the developments. They're measuring, absolutely important, they're measuring it, and then they're offsetting. So that's the full cycle. And I think there's definitely opportunities to invest in the systems that are doing the measurement. I mean, you can save so much money if you just have more efficient HVAC in the buildings, if you have more efficient sensors. God knows my apartment in New York, it's on and off. You either blast heat or you get nothing. It's ridiculous. So, and that's a Brodsky building, and that family certainly has enough money to fix the buildings if they wanted to. So it's going to take some nudging to get the people that have buildings to do it. But, and that's why in a lot of the world it's being forced on people by regulation, because we have to do it. The planet's going to burn down eventually, so we have to do it. Most people will not do it unless they are forced to do it by regulation in existing properties and new properties. I see much more of an embrace of building from the ground up and adding all these features in from the beginning. And for single family homes, I see people, even out here in Long Island where I live, very interested in putting solar on the roof, you know, putting in more efficient heat pumps, putting in better windows in their homes. I mean, hurricane proofing, because suddenly the storms are getting worse in Long Island. So Florida is going to go underwater. All those multi-billion-dollar condos in Florida are going to be worth zero if they don't do something about the rising water that's hitting Miami and the floods they get every week. So, you know, I think it's an area of great opportunity. That's why I didn't buy a condo in Miami. I absolutely love a condo in Miami, but I think it's going to be worth zero. I think a condo in Park Avenue is going to be worth a lot more.
I just need to.
What big storm is going to take out Miami?
What people don't realize, because people in California hate people in Miami or Florida, is that Florida sits on a shelf. Orlando is 600 feet above sea level.
Yeah.
All the places that vote Democrat are in South Florida, which is 6 feet above sea level. So they're the first places to go.
Well, I would say South Beach.
Fort Lauderdale.
Hey, a lot of hedge fund guys. A lot of Republican hedge fund guys.
Hey, go on.
They're out there.
We could build Venice again.
First an observation, a couple
Question,
questions.
sure, go ahead.
Observation from Morgan, here we go. The cost of $320 to retrofit green efficiency, decline of post-conversion rentable space, the price represents a 60% decline in price per square foot from pre-pandemic levels. So when people reconvert office to residential in green, they're getting screwed, okay? That's a fact. Okay? Let me ask a couple other questions though. You're sitting here.
You're saying repurposing office to residential?
That's what they say here.
Well, it's almost it never works.
That's right.
They're not
So
built.
it's
to be
it's
They're not built to be
We're not
residential.
talking about
Let me
that.
ask
We're
you-
not talking about that.
All right, so let me ask a couple questions.
Uh-huh.
We're staring at
It's McCarthy.
2024. First quarter 2024, okay?
Yeah.
Number one, what's gonna happen when the auditors and regulators come in and look at the books of the regional banks who own 70% of commercial mortgages, where it's been underwater, and what's gonna happen to that? Okay, it's a major problem around the country with funding. Part of the reason why it happened last year, the first quarter, was that you had mismatched maturities. You were lower for longer in commercial real estate space, and your loan book in many commercial states were yielding 2.5% to 3%, you're borrowing 5 to 6%. You can't make that on volume, okay?
Right.
So my question is, and you got a refi risk out 2-3 years as well. So where are we in the commercial real estate space in terms of office and malls, as opposed to data centers, which may be attractive, and some other attractive areas in the real estate space? Love to hear it.
Well, I can talk a little bit about the office side and the residential side, not so much about malls. But, let me just take it back a step first. I mean, one of the things a few of the key things that I look at in terms of where we are cyclically is inflation, interest rates, and unemployment, right? So inflation, we've sort of had, and there was an inflation report today, latest CPI report.
Yeah.
Has been coming down somewhat all year. When we last did one of these panels was September. At that time, the monthly inflation was 0.4% and the annual was 3.7%. As of yesterday, they had 0.1% and 3.1% annually. Now,
How does that affect pricing in real estate next year?
what's that?
How does that affect pricing in real estate next year?
Well, it affects it because it goes back to interest rates, okay? So
What do you think interest rates are gonna be next year?
if I knew that, I'd have a big bet on the treasury market either way.
Because it's not gonna
But,
happen.
personally, I don't think that the market, the stock market, for example, right now is thinking that the Fed's about to start cutting rates.
Oh shit, go twice maybe max.
Yeah, I don't subscribe to that either, but we'll wait and see. Let's see what, for example, Powell has to say tomorrow to give us some additional insight.
I'm
But
sorry, so you're saying Fed is not cutting rates?
Fed's gonna cut, if they
So-
do, they'll cut a couple, and they'll do it in the fourth quarter.
so is it,
2024,
right,
yeah.
so if
Okay,
that, if,
I just want
if
to put
that's,
this down in writing.
if
If
that's,
that, they may not do it anyway.
if that's the case, we do have this wall of debt coming.
Yes, big.
There was, Signature Bank traded a big portfolio recently that Newmark handled. Howard Lutnick of Cantor, which owns Newmark, was on CNBC this morning talking about this, and it was his view, and not that he's right, but that his view, that the problem's gonna persist into 2024, except but the banks are gonna start selling. They're gonna use sales like the Signature Bank one to sort of set the market, and they'll start hitting the bids at the lower prices to get out of the real estate. That'll enable other buyers to come in at lower basis where they can maybe rent properties, at a decent return. But again, he's also partially talking his book, right?
Yeah, he probably bought how much was the discount on the stuff he bought?
Well, he didn't buy, they were earning the brokerage fees for managing this,
Yeah.
managing the sales here. So, but, so that's a scenario. I mean, so if you have rates higher for longer,
They are gonna be high.
Well, another thing McCarthy didn't mention though, is that there's this whole thing of universities are going out of business, right? There's a whole sector of selling off university
Properties, that's true.
property and land. That's not
But you
big, but
focus on the office, you focus on the regions, you focus on the problems. I would love to hear your sentiment.
right, and
The problem is that the commercial real estate, we're in the first, or second, or third inning, the 9-inning game. There's gonna be a lot of pain when the auditors and the regulators come in and talk to the banks and exactly say what's going on. Love to hear your thoughts.
I've lived through the credit crisis.
So
The
far.
banks, yeah, see, the banks that have been closed down because they have had a problem with their, not the asset side, it was their liability side.
Right.
They've had essentially uninsured deposits. The rest of them,
Securities. They're gonna-
so what I'm saying is that the banks the regulators will close their eyes. as long as there is no run on the bank. There won't be a run on the bank because,
We mergers.
no, not only that,
Was
well,
that
they
February
did that as
one,
well. No, because if the deposit is insured, you don't care. I was sitting at the First Republic, if, I had that, for my business, it was below the limit, I stayed with it, right? So you don't really change banks. It's not an easy thing to do. Nobody wants to change banks, and FDIC and others will close their eyes. In 2008, we were ready with a big check at BlackRock and Post. None of the banks were willing to sell assets. People were crying they said, why are they not selling? They essentially extended
Pretend.
and pretend, and that's going to happen. The Fed will instruct them to do
So 2008 to now, it's 15 years later, what's changed?
nothing. As far as the banks, the way they work, they're all under essentially a system where the Fed can do anything they want, keep them alive, as long as they're doing the right things going forward. So they're going to live through the cycle, and the question is whether they're going to. For what is not clear what's going to happen at CMBS market. CMBS market is the commercial mortgage-backed securities is now in the hand of the privates. If the borrowers cannot make the payments, and they're going to have to give the keys, right? And the special servicing. If I was going to invest money today, I'll try to create a special service today. That's where you're going to make a lot of money, right? Because you're going to.
Bottom fisher like Bill Gross and buy regional banks is on the bottom.
I'm not sure the valuation of the banks are that attractive right now.
That's what he seems to say. It's pretty
And
damn good.
in terms of the banks foreclosing, they don't want to take ownership of the.
No,
property.
it's not Europe.
I think if it seems like there might be some relief in the rates toward the second half of the year, the regulators and everybody else are going to float on through, because the last thing they want to do is start calling all these loans and marking down these assets, because it's passing a hot potato that nobody wants to catch.
Well,
So
the
I
other-
think you're just going to see people turning a blind eye and seeing how it goes through the first half of the year.
There's an election coming up, right?
Yeah.
Exactly. An election year, they never do anything in an election
Rates are
year.
not gonna
Either
help
party.
them.
I'm sorry?
It's just going to be a year where they just kind of muddle through. And the loans the loans are going to get the extensions they need, because it's all hot potato. Plus, a lot more people are going to put more money into the private debt funds, and they're going to go cherry pick some of the better loans. And privately, banks will these loans as well.
Well, the other thing too is that while rates they went up after we did panel in September, we were in the low fours, went up to 5%, came back down to the low fours now, talking about the 10-year. The 2 years, more like 4.7, went over 5, came back down. What hasn't come down is SOFR, right, which is really the short-term rate that a lot of the lending is based off of. Any of the floating rate lending that people have, existing, they're not getting any break on rates, because SOFR's been stuck at basically 5.3 the whole time. And when we look at doing the private credit business, we're lending off of SOFR. So our loans coming in at SOFR plus, 400, SOFR plus 500, SOFR plus, some at 700,
So that's
750.
8 or 9% you lend.
Depends on, you can tranche it up,
So you're not gonna get down to 3%, under 3% mortgage on residential or.
No, but that's, but listen, it's for the owners that can put more capital in it, it's part of the kick the can strategy. If you're sitting there with condo inventory, for example, you have two choices, right? You can try and blow out a bulk sale at a big discount, or you can hold on and sell them at, continue, the market's strong enough, maybe not volume wise, but price wise, right? You can talk about it where if you've got a 2,000 square foot building, you don't want to blow it out at $1,500, $1,600 a foot, even if you can.
And I don't think they feel
You
like
can
they
still
need
sell
to.
it, right?
I
Well,
feel like they will do exactly what we're
right.
talking
So
about.
they'd rather, some owners
There's no
would,
fire sales here.
some owners would rather pay 10% on a loan and give them time to continue to sell. And part of the reason is not so much because they can still make money at $1,500 or $1,600 a foot, but if they start cutting prices, that's going to affect their financeability in the future. Because
Correct.
lenders will look at them and say, why should we believe your prices? You cut prices here big time before, and you'll do it again. And we're not going to.
The other thing that's different from 2008 is it's called private debt. You got $1.5 trillion in lenders out there, up to 3.5 trillion over the next bunch of years. You got a lot of private people disintermediating banks. When you start to think about that, who's going to pick up the stuff when you
But you have to recognize, private debt is looking for 15+ yield.
Sorry?
Because private debt is competing with, private equity. They want 15+ yield on their, they're not
Oh, they
cheap.
prefer.
Yeah,
But they go down below. So
they're not gonna be the senior
No,
borrower.
but that piece is different. So people are going to borrowing there, in many cases, or real estate or middle-sized companies to go to borrow private lenders as opposed to the banks. The banks have more capital. If Basel III goes through, they have more capital, the big banks. Okay, so that's be a problem.
The problem is, you're not gonna get the banks now lending. A lot of them essentially kind of a stop. They need to deal with the existing problems,
Yeah.
right? And if you don't have a senior capital, right, you got a problem. A senior capital, senior portion of the capital is about 65% of the stack.
Yeah.
Right? And so that's where we're saying the senior is the most expensive piece of the capital right now. As you said, the mezz, the preferred is there because they're going to get to where they need to get on the yield basis.
And in a city like New York City, the other problem you have on the multifamily side is the age of the buildings. If you have older rental buildings, right, you have rent stabilized tenants or rent control tenants where you can't raise rents, plus you've got you've got interest rate inflation, you've got cost inflation to run your building, and you can't finance. You're getting killed every which way. On the other hand, if you have a market rate properties will do much better because they can pass on a lot of those costs through rent increase. So you kind of got to say, what asset class am I looking at? I'm looking at an older construction building or a new free market building.
Yeah.
Stuyvesant, if you remember Stuyvesant, right? Then BlackRock acquired it. They essentially lost about $2 billion in the asset. It restructured. I assume that's going to have to restructure again, right?
I'm not familiar with Stuyvesant's capital
Stuyvesant,
structure.
no,
Stuyvesant Town. Yeah.
Stuyvesant Town is,
No, I know
primarily,
High-town, middle-class income after
Yeah,
World
Yeah,
War
but the
II.
rents
That wasn't being run by the roads?
here, so maybe they're getting.
Not-
rents
so
by-
they became market rate already?
They're market rate, yeah. It's almost luxury at
No,
this
it's a
point.
hedge fund.
Huh?
I think Blackstone's
Yeah, it's the expansion of the rents and rents are so high. It's not going to save everyone. If you're rent control, that's the problem. Is like we talk about regulation. This is the worst place to own rental properties. Because unless you buy in at a great price, right?
Right.
Like, so how does it, what other markets are, I mean, I love New York, but where else would you put money to work? Like, what about the Smile States? And would it be multifamily or industrial? I really don't, I'm looking at the Observer. Not one of these top lending officers are talking about lending in industrial. They're all talking about multifamily. It's like, that's where the money should be going.
Data centers.
Data centers to an
Student
extent.
how
Yeah.
I mean, there's a real housing shortage just in general, right?
Everywhere.
Well,
Upstate New York, it's everywhere.
Yeah.
It's a policy issue that's happening.
Yeah.
Los Angeles has over 1 million shortage of affordable housing, right? They're paying $600,000 for homeless,
Right.
so they're paying up. They're fast tracking. They're giving you entitlement on industrial properties converted to housing. So there's a lot of opportunities. We're seeing developers going in, grabbing essentially industrial building,
Right.
getting entitled to build a 7-story high.
But smaller homes, right? There's a focus on small, just.
Of course,
That's it.
I think the statistic was that San Francisco was creating 50,000 head of household jobs a year for the last 10 years and only building about 5,000 housing units a year.
There's definitely
So
not
that's
a
like
oversupply
10x.
of housing.
It's not sustainable.
Yeah. So that's where the opportunity is smaller, more affordable,
Right.
Yeah.
workforce housing, you want to call it, like,
great.
where do you build it, and what municipalities are excited to have it. There's a lot of NIMBY going on,
Yeah.
across the country.
If you really want to put money, go to India, invest in essentially dormitory style
Right?
homes
some,
for factories.
I used to work in shipping in the maritime industry. They have the shipping containers.
Yep.
And there was one area that was literally converting these old shipping containers into small, apartments and just literally stacking them.
Yeah,
They're making cannabis,
Yeah.
vertical farming.
Tiny,
out of it.
tiny homes are like one of the fastest
Yeah.
categories, prefab tiny homes that are really luxury for the smaller families that exist now. They're not building a lot of bigger houses, I think if somebody can just pump out, 2-bedroom, 2-bath, tiny homes and put them all across the country,
Right.
they're gonna,
Well,
they're gonna make money.
that's what some of the build-to-rent companies are doing, not
Yeah.
so much for sale, because because of the cost structure, they have to build smaller units.
Right.
It's not that the
yeah, to keep
market
the
is
rent
demanding
normal.
it. They're basically saying, well, we can throw together a 2-bedroom, 1,200 square foot house and no living room.
Yeah. Right.
And,
As big as
the
this
problem is
coffee
gonna be
table.
is when you go to sell those proproperties, who's gonna buy them? There's not gonna be any,
When I
Here's
sell my
two
place in
statistics for
Philly,
that.
we buy 2 of those.
Research statistics from real estate. Various research suggests that the US is short somewhere between 1.5 million and 6 million homes,
Right.
okay, across the board. That's the study that came out. The other thing is, that you
Convert
turn
that to
on-
beds, maybe.
okay, the other thing is that according to Goldman, somewhere north of 70% of the outstanding mortgages are below 4%. You
Right.
can't do that and make it up on buying, we're looking 7 and 8%, stuff like here.
well,
We're in
those,
for a long, long period of pain. here.
those people are not gonna be selling their homes.
That's right.
No.
They're
But-
not in the market, so velocity is
what-
down, prices are stable, and in some markets strong. And it's to the point, so you've got this big affordability gap, right? Because prices have continued to go up, but incomes have not gone, the portion of your income to cover the housing costs is at the lowest level.
Yeah, it's not
sort of
33%
ever.
anymore, it's 50%.
But
Yeah.
there's tons of land available in upstate New York. You can just do commuting from upstate New York, go up to central
Who's building up
Pennsylvania.
Well, but people are leaving New York as a net
That's what I'm
outflow.
saying.
Land
you have
prices have
land-
But
doubled.
there's been some investors coming down from Buffalo that, I think Buffalo, not just because of the Buffalo Bills, but Buffalo is booming. Oh, go Buffalo, go Buffalo. I think Buffalo's been booming in real estate and doing better than it was in the past. I don't know.
Yeah, there's a trend now of a lot of the younger millennials moving to these small, really small cities, not even tertiary. There was an article today about people moving to Indiana from Austin, interestingly enough, because Austin's gotten too expensive. People went from California to Austin. Now they're going from Austin to Indiana because it's cheaper there. Because a
that's
lot of
because-
jobs are now remote. You can live in a place that's cheap, raise your family, maybe do it on one income if you don't have to put so much into housing. So I agree. If you go to a really small, interesting city, you can revive it. You can buy a lot of, even out in Long Island, Patchogue was an example. It was burned out basically. And it got bought by a bunch of local people. They fixed it up and now it's a mecca for entertainment. So people are drawn there and they're making a lot of money.
Mhm.
So there's not, it depends on, as a family office, it really depends on how involved you want to get. Do you want to have
It's
to
like,
go
there's a
and
lot
do
of
the
those
work?
stories like Boise, Idaho, and other areas that became really popular during the pandemic and so on.
But you should also have an international lens, I think. Africa is definitely, is going to be one of the fastest growing continent.
2 minutes.
And there is a huge amount of shortage, obviously, and there's a huge amount of money going in order to be able to cover our sins, which is creating, the global temperature thing. And you can see it if you're in Middle East right now. If you're in Abu Dhabi or Dubai, you'll see that it's become a brain drain from Europe. They're coming there to position to be able to attack the African continent.
Like,
So-
like the more developed parts first, like Nigeria and. is it-
Of course, Nigeria is 300 million people, right?
Yeah.
And Kenya,
Yeah.
The other 6 point in this article is about mortgage affordability, which happens to be
Yeah,
true
yeah.
in Canada, Australia, and other places. We import the mortgage and do a deal with somebody that's buying. So you're looking at the 4%
New
mortgage.
York City has it.
Yeah, mortgage affordability, that's another thing that's evolving. You can take 3 or 4% mortgage and give it to somebody that's not gonna pay 7 or 8%, but work some angle out of it in terms of buy a real and stuff like that. That's another angle.
Like self-financing?
Yeah. basically.
What are you assigning your mortgage to
Yeah,
them?
that's right.
No, you can actually, you're in the mortgage business, that's your man. Oh, of course, yeah, absolutely you
Really? I
can,
didn't
and
know
you,
that.
and you also,
That would be nice.
no, absolutely you can, in New York City, we
Mortgage
have
portability right
had,
here.
yeah.
Mortgage portability, I never heard that.
Oh, no, yeah, and you have
Trying to
to,
educate you.
by the way, you also,
I come here and educate.
Listen, you're very impressive with your research.
you also save, you also save mortgage, the 2% mortgage tax. We have assigned mortgages,